Welcome to the Thematic Investors podcast, powered by Vidrio Financial. Vidrio Financial is proud to support the Thematic Investors podcast with host Kieran Cavanna. Vidrio helps allocators harness the investment complexity to make better allocation decisions. Learn more at vidrio.com. That's VIDRIO.com.
Welcome to the Thematic Investors Podcast. I'm your host, Kieran Cavanna of Old Farm Partners. Our goal is to bring you great investors in the themes they are working on. Some are under the radar, and we think they're all experts in their disciplines. This podcast is sponsored by Vidrio Financial. Lucky for us, we have one of the best European investors I know to talk to today, Stuart Mitchell, who runs the eponymous SW Mitchell in London. Stuart has an outstanding long-term record in European equities. I've known Stuart for a few years, and his curiosity and passion for investing is instantly palpable. He's put together a long and impressive investment record, and today has a very strong view on where he thinks European stocks can go. Welcome, Stuart.
Hi there. Very good to see you, Kieran.
So a short version of Stuart's background: he set up his firm in 2005. And prior to that, he was head of special situation equities at J.O. Hambro, where he managed the Charlemagne Fund, running both a long-only and long-short strategy. He had a very strong performance record. His long-only fund at Hambro was up 133% over his tenure, with European indices basically flat. He spent 35 years investing in European stocks. He's born in Scotland and educated at St. Andrews, where he studied medieval history, which I'm sure we're going to touch on a bit. So Stuart, maybe you could talk a little bit about your background a little bit more and how you got to this point in your career and why you do what you do.
Great. Well, thank you very much, Kieran. This, again, my side, what an honor to be on your podcast. Thank you very much for asking me to talk. I mean, I guess rather than really running through my career, I think there are two or three for me really important moments and experiences which I had, which have brought me to where I am today. And the first was as a young, straight out of university in Scotland, coming down to London. I was very lucky to work with John Armitage, who I think you know well, and many of your listeners will know well, of Edgerton Capital. And I sat right beside John for 7 or 8 years before he went to set up his own business. And for me, that was an extraordinary experience because I was really able to work with a master, a fabulous investor. And what he drilled into me was just the value of unemotional, very thorough analytical research. And also John was great at making you think a lot about balance sheet strength and goodwill and the ability of a companies to go through difficult times. I think the second thing for me, Kieran, that was very important was I was very fortunate to, after I left Morgan Grenfell, to be a partner at J.O. Hambro, and we had an extraordinary few years. And we sold the business to Credit Suisse, and they offered us a very generous price. But I always knew that I would never be able to generate the kinds of returns I generated in the past if I was within a large organization. And we all know about it, all of us who've been working in big firms. In the end, the bureaucracy, the controls, the procedures, the politics just overwhelms you. So I knew that I had to set up my own business, and I knew I had to set up my own business in a way which would give us the best possible chance of achieving great returns. And I think maybe just as a last kind of introductory point, it might be worth just saying one or two things about how we tried to set up the office. And it seemed to me over time that, the way you've got a chance of doing this is being able to spend 99% of every second thinking about the portfolio and thinking about new ideas, but also creating an atmosphere where there's not too much emotion, there's not too much, as it were, there's not too much, when markets go up, people get euphoric, and markets go down, people get depressed. And so we made a decision right at the very beginning not to have any traders in house, and we deal all through a computer system. We deal with a group down the road. So all you have in our little office here are 8 fund managers and analysts who are thinking the whole time about stocks. And I think that's, and we're a group of people again who work together our whole lives. I mean, most of us have worked together now for 30 years. So I think we've really tried to create a kind of an environment, a culture which will give us the best possible chance of generating great returns.
Before we jump into the ideas that you're investing in, I know overall you're very bullish as I've ever seen you. And maybe you could talk about your overall view on European equities at this point. And I know you've said after 35 years, this is the cheapest Europe has ever been, and particularly the things you're investing in. Maybe you could touch on the top end before we get into some of the individual ideas.
Great. So Kieran, it's as we've talked about before, the context is quite an unusual one for Europe because, of course, we've had this period of falling interest rates, and we've had this rush of money into the technology sector and into growth companies. And growth companies, even with modest long-term growth expectations, have gone up to valuations which we've never seen before. And of course, you know how these things develop. At the beginning, companies get to reasonable valuations and they discount a new level of interest rates. But of course, what normally happens and what we think has happened this time is we've had this extraordinary bubble that's been built up, and we've seen companies with really modest growth prospects go to extraordinarily stretched valuations. And particularly in the technology sector, we've seen some of the flimsiest business plans and the most unlikely companies to succeed commanding extraordinary valuations. And of course, that kind of Europe kind of gets left behind in a context like this because we have great technology companies, but it's a very small part of our index. We have great growth companies, but again, it's quite a small part of our market compared to America. And I think I'm right in saying that American index is about 30% technology. In Europe, it's around about 5%. So it's a very different shape of market. And of course, our market, as you would expect, is dominated by old economy. It's pharmaceuticals, it's oil and gas, it's banks, and it's utilities. So our market has been progressively derated. But it's very interesting what you say, Kieran, about it being an unusual time and valuations being as low as they ever have been. Because normally when we've had valuations like this, it's been after a shock. So the first Gulf War, and which I remember very well, or going back to Y2K, or going back into the Russian default. There was a moment when European equities derated, but they tended to rush back up to more normal valuations again. This is so unusual because it's now a very prolonged period of derating, and the discount against other markets is as wide as it ever has been, and it's endured, which is really unusual. So just to give you some kind of an idea, the trouble with this, looking at markets as a whole, of course, is that there are different markets have different shapes, and there's more technology, more growth, and this, that, whatever. But if you just look at the European market compared to the US, it trades at about a 65% discount on price to book. And price to book's a really nice thing because it's at the end of the day, book value is what really matters, doesn't it? And people can do whatever they like to their earnings, and the cycle can make their earnings look good in the short term, not so good in the short term. But again, book value is should be the real value of a business, particularly quoted companies, which tend to be reasonably dominant and have a franchise which should endure. So even if I adjust for looking at the American market, there's more in technology, and I do same sector weightings, the discount is still about 50%. It's very, very, very significant. And of course, there are all sorts of, we'll probably go into this more later on. The European economy hasn't grown quite as quickly as the US economy. And of course, everything's been happening in the US economy with Alphabet and with some of these great technological innovations of the last few years. But again, it's kind of striking the discount is so big. And I think maybe for us, and because we can cut it and look at it all sorts of different ways, but I think for us, the most striking thing perhaps is that when we compare our companies with the best companies in the rest of the world, in the past, they used to trade roughly pari passu, and particularly the larger, very well-known companies. And now, more than often, they'll be trading at 30 to 60% discounts. And that's really, really, really unusual. So it won't be explained by growth rates. It won't be explained by levels of profitability. It'll be more to do with that it's the companies which are trading in a market which is very out of favor, and of course the flip side of it, in America, there's just so much interest, there's so much money flowing into technology and growth that those stocks have perhaps been overly favored.
I mean, we can. Sorry, go ahead, Stuart.
Maybe, Kieran, just as one kind of last kind of throwaway. I mean, we can do it right across, whether we compare one of our banks, our best banks, with one of your best banks, and the discount will be 50%, and the profitability will be very similar. The growth rates will be similar. Our pharmaceutical companies, again, they'll be trading at half the valuation. The profitability growth rates will be very similar. Maybe the most striking because you can compare them pretty directly are the great oil and gas companies. Right. And I know we got all sorts of criticisms of the way BP's been run in the past, but it isn't that much less profitable than Chevron and Exxon. It hasn't, it isn't growing really any more slowly. It's perhaps investing a bit more in alternative energy, which you might argue is a capital which will be squandered. But a 60% discount we just find so extreme.
Right. I mean, I think people listening to this understand the technology focus in the U.S. and but it is extraordinary to have like for likes trading at such a big discount at a time, don't you think, also when there's a lot of shifts going on in the world to be, and we'll get into this a little bit, but certainly what has benefited probably more than any area has been globalization, these kind of technology companies. And you're seeing a significant shift in that theme after a long time. So, but you touched on energy right there. Do you mind going through a little bit more on energy? I know Noble Corp is one of your biggest positions right now. You've talked a bit about how, why don't we talk about energy first, and then I want to talk a little bit about the EU.
So, energy, of course, is fascinating, and it's the way we think of it is all these kinds of sectors, whether it's energy, whether it's basic materials, it's kind of the experience of those industries is really the flip side of what you've seen in technology and growth. So we've had this extraordinary level of investment in technology, and of course, there's only a certain amount of savings in order to be able to. So at the expense of all that money that's gone to technology, some of those more older economy industries have been starved of capital. And the numbers are kind of startling. So if you were to look at copper or iron ore or oil, then the level of capex over the last 10 years is about half what it was in the previous 10 years. And of course, oil is this whole thing has been turbocharged. So the first, of course, is it's just been very difficult. If you're a oil and gas company trading on 4 times earnings, why the hell would you raise equity capital? It'd be dilutive. You just wouldn't do it. So it's been very hard for them to raise equity capital. So they've cut back on investment, and of course that has that extraordinary impact of you start to your depreciation starts to be less than your capital employed. So you have less kind of your capital base is beginning to fall at a time, of course, when growth is continuing to advance, and but of course the other turbocharging thing in our little industry in oil and gas is we have not so much in the US, but we have a very powerful green lobby in Europe, and there's a really kind of almost fanatic move to go to electric vehicles and other forms of energy, and of course that's meant that people running these large oil and gas groups have been under tremendous political pressure to curb investment and to put it into alternative energy. And I think you once, when we met, Kieran said to me that you've heard so many people come into your office and they've try to tell you what the oil price is going to do, and it's a mug's game. It's extraordinarily difficult, but I think what we can say is that demand is likely to rise a bit more quickly than most people think, and that's all to do with we think there'll be kind of a J curve in the move to alternative energy, just because where we are at the moment, and perhaps something we can talk about later, with where interest rates are today and with the cost of buying things like wind turbines. It's basically just, unless you've got massive government subsidies, there's no way you're going to invest in those technologies. And our guess is that oil and gas demand will be quite a lot higher in the short term than many think. But the one thing we can be absolutely sure of is the amount of supply. And supply just ain't going to grow. And the majors are, if they are investing, it's basically keeping production at also, at stable levels. And there'll be one or two, perhaps like BP, who are seeing a bit of production growth, but that relates to their history. But again, it's for the industry as a whole, it's basically flat. So we should see quite a tight market. We should see the oil price 80, 90, 100, $100 a barrel. And at that level, in our view, our stocks are a total steal.
I mean, I think, given depletion rates plus less capex, I mean, it's not even someone who can do arithmetic like me understands that. So, one thing that's interesting about, touched on a little bit on the EV push in Europe is, I'd love for your view on this, is that it seems like the European Union is, ever since COVID, has been far more united in how they act. And I mean, COVID response, Ukraine war response, certainly, I think is a big one. I remember you wrote a piece about how the world how Europe is having its Hamiltonian moment. And I think I understood that because I'm a Hamilton fan, that it was a federalization or centralization type of action. Could you talk a little bit about that?
Yeah, it's well, I have to be quite careful because at times I got a little bit perhaps over enthusiastic about this. And it seemed to me that the recovery fund was really quite an important milestone because it's basically €1 trillion of capital, which is going to be financed by the ECB. So it's going to be, which is basically effectively jointly financed by the European Union, which is an extraordinary move forward because in the past, of course, it's always been individual states issuing bonds and coming together to do some kind of a program. And €1 trillion, is quite a meaningful amount of money, particularly because half of that money will be redirected towards the two of the weaker economies, Spain and Italy. So it really has should have quite a dramatic impact. I mean, there's all sorts of problems you'll know about the various schemes and the way the money is going to be spent in Italy and the approval process, and there's been delays, but it should add 3 or 4% to each of those economies. So it's quite important. I mean, our hope is, Kieran, that it's just the beginning and that the next stage we have we think there could be another trillion, which could be an infrastructure fund, pan-European fund, pan-European, which will be financed by, ECB, which basically is all the European states coming together. I mean, it's not overt; it's kind of covert, but we're well on the way to I guess, mutualization of debt happening. But I think it's really interesting, your second point about a war. I mean, we as historians, we always think, what is it that brings countries together? And normally it's a threat of invasion, and whether it was England coming together into one country, all the different separate kingdoms because of the threat of the Vikings, or similar arguments up in Scotland, or whether it was Europe coming together because of the fear of France being invaded by Germany and the fear of Germany invading France again. So our guess is that Ukraine should help move all this forward, and we really need to come together, particularly if if Trump becomes president. There are all sorts of questions around NATO and what will NATO look like, and whether NATO really will come, and whether America really will come and support us if there's further aggression on our eastern borders. So our hope is it's the beginning of something which will maybe not become like the United States, but will be becoming closer together, and that should stimulate growth. It should stimulate economic growth.
It's so interesting, and as a quick aside, I can't tell you how many good investors, great investors I know who were history people to some degree, and I know you were medieval. It's interesting. That could be another podcast too. But maybe it's a good segue into defense spending. I mean, how do you think? Because I know Europe it's subtle. I mean, people think of the U.S. as dominating defense, but Europe has a very robust defense industry across, especially Germany and France and England. So maybe you could talk a little bit about that and how you think things play out in that industry.
Yeah. It's such a great question, Kieran. So we've been thinking a lot about this because, of course, there's this Russian act of aggression, and we have a whole lot of defense stocks, and we had to think very quickly: are these interesting investment opportunities? And it was actually a subject of one of our thought pieces, and we got together various generals, and we got together various leading civil servants, and we got together from the head of MI5 and other very interesting people to debate and to think about this question. And it's quite difficult. I mean, our conclusions, we're not sure. So of course we have this act of aggression from Russia. Will that stimulate extra defense spending? It may well do in the shorter term, but doesn't mean that Europe moves to a structural level of higher level of defense spending. And we're not totally sure. So we have this target of 2%, as you know, of our GDP spending. And we're still below that for many European countries. Now, does this war and does if we have a Trump becoming president, does that mean that we move very rapidly to 2% or above 2%? Again, we're not totally sure, and why are we not totally sure? Well, it's just 59 years old and having experienced European politics, it's the amounts of money are very, very significant, and there are all sorts of welfare programs, and it's really hard to find, areas of spending to cut in order to replace defense spending. So our guess is that we might move somewhere near to 2%, but does that really mean that we're going to be the industry is going to be growing faster than it has done in the past? We're not sure. It has done in the short term, but we're not sure. I think the other question, Kieran, which you raise, which is so interesting, is where the hell does the money go? I mean, our guess is if there is extra spending in Europe, probably 70% of it will go to America.
Wow.
And why the hell is that? I mean, there are the two reasons. The first is it's a kind of a quid pro quo. It's America spends a very significant part of its budget on defense, and clearly it's the main partner in NATO. But kind of the deal is if we're going to only pay 1.5%, 2%, most of our orders should go to American companies. But I think there's something perhaps more important and real than that, is that America basically holds the cutting edge technology in most areas. So we have a very reasonable fighter jet, but we don't have a stealth jet yet. And both Dassault and both the Typhoon are very reasonable jets, and they probably perhaps traded a discount to what you could buy in America, but not obvious if you were making that decision that you would go for the European option rather than the American option. And of course, there are all sorts of interesting deals, and it's combined with whether you'll take F-35 orders. So our guess is there's some great areas of expertise like submarine technology where we have leadership, like missiles, like radar technology, and we do very well in that. But outside that, it's the world, it's really dominated by America.
Wow. I know a lot of this, your thinking stems from bottom-up thinking as well as top-down, and you do a lot of these top-down pieces. I mean, why do you do big top-down pieces? I mean, I thought you wrote one on hydrogen that was really, really impressive, and your conclusion was not absolutely we need to go long these things. I mean, does this drive some of your thinking at times? I mean, does it really help you as an investor?
It really does, Kieran, because when I chatted at the beginning a bit about the way we do things and how we try to create this group of us, 8 of us here, and we don't have traders, and it's very calm, and we try to be as unemotional as we can so we can make, we think, the best possible decisions. And everything we do is kind of looking at areas where perhaps people aren't looking at, or areas which are perhaps unliked. And of course, those kind of areas, there tends to be really a very limited amount of research out there that you can either buy or that you can perhaps access through the brokers. So we really do pretty much everything ourselves. So all the work on oil and gas we've really done ourselves. And hydrogen, again, was a very interesting one, Kieran, that we worked on. It was right at the very beginning because there was the change, and particularly with COVID, there was the acceleration towards alternative ways of energy sources. And so we thought we really should make sense of and try to get down to do some work on hydrogen. We couldn't really find anything out there. So we did a lot of work, and we had 2 or 3 of us involved in that. And I mean, the challenge with hydrogen is, of course, it's kind of a crazy energy, really, because you've got to have the electricity in the first place to split the water to get the hydrogen. And okay, that's kind of fine in a way. Where it would make sense is it could be if you could store surplus solar energy or wind capacity generated over the day. If you can store it, then if you can have a hydrogen site, so a place like in Spain or in Italy, it could work out. So you could perhaps crack the hydrogen, but it's very expensive. It's a very inefficient method. You have to put in a lot of energy to get not much energy out. And then you've got to transport the stuff. So the trouble with hydrogen is by the time it gets to where it's going to go to, and there are a few, like buses in London some of them run on hydrogen. There are a few. It's just so inefficient that you're not doing anything at all to help the carbon footprint. I'm afraid on our work on electric vehicles, it's not obvious either that the carbon footprint is much less with electric vehicles than it is with the internal combustion engine. And one of the things we've done, and we have no particular axe to grind one way or the other, but of course the challenge with electric vehicles is that you've got to produce electricity in the first place. And in most countries, it's still got 50% gas, and it probably will be for forever because we don't have enough sun, we don't have enough wind. And by the time it gets to the electric vehicle, you've only got something like 20 or 30% of the initial energy you put in. Whereas at least in an internal combustion engine, you're getting an efficiency of something like 85% or so. So it's kind of complicated.
Do you think that I've been thinking a lot about it. Do you think that the ESG push, which has been much stronger in Europe than anywhere in the world, and obviously there were some big problems in 2023 with offshore wind, that accounts for some of the discount in some of your traditional oil and gas
Great
majors?
observation. That's just such a fantastic observation, Kieran. I mean, it's the challenge. And so if I look at Chevron, Exxon, they're pumping most of their capex. They're very generous to shareholders, as you know. But if you look at their capex outside what they pay off to shareholders, basically 95% goes into oil and gas, and only 7% go into renewables. And when it goes into renewables, it's really clever renewables. It's all about where it makes sense in some areas where you could do wind, and where you have you're fully vertically integrated. So basically, you're just somehow creating electrons to sell directly to your clients. It can make sense. The challenge we have in Europe is the pressure has been so significant that most of our oil and gas companies are probably spending about 30% of their capex on oil and gas. And this is really, really, really difficult, Kieran, because the trouble with all of that is, I mean, oil and gas guys know about oil and gas, and they've been doing it for years and years, and they have a pretty good idea, the time of the cycle to invest, and they have a pretty good idea. They can judge because that's where all their experience is. But of course, oil and gas, like everybody else, is completely new to hydrogen, completely new to carbon capture. It's completely new to running wind farms and negotiating with government subsidies, completely new to running solar parks. And of course, the risk of screwing it up and getting it wrong is very, very, very high. And we can just about understand charging stations, electric charging stations. That'll probably work, and that should be profitable. But offshore wind farms are really, really difficult, because most of the deals will be some kind of a subsidy for 6 or 7 or 8 years, and then after that, these guys are on their own. And it's just, we could conceivably have a real surplus of electricity 6, 7, 8 years time, because we have both traditional, gas powered being invested in, plus we have all the new type forms of energy. It's conceivable we could have a very significant surplus, and that many of these offshore assets could actually be significantly loss making. So we've already had the first write down from BP, which is incredibly annoying, $500 million write down. But our guess is, Kieran, that's the first of many. So when we valued BP and Total less, because we think they've done it more sensibly. But BP, I think you can probably say that half of what they invested in will be worthless.
Wow.
So you've got to take that off the market cap with covenants, which there aren't, but you still get a dramatic discount against Chevron and Exxon. I mean, our hope with BP is with the new chief executive, there will be an about turn. We put enormous pressure on them, of many others. I mean, just to give you an idea, I shouldn't be getting emotional about this, but I am, because it's just annoying. So if you look at the amount of money which BP invested in renewables, guess how much of their market cap they would have been able to buy back if they hadn't done that?
No idea.
It's 25%.
Wow.
So it's kind of crazy, because this is stuff which we think we're pretty clever, and we have the best people we can speak to who look at these projects right across the world, and we're all scratching our heads. It's not obvious that any of these investments are going to cover their cost of capital. In fact, they could even be loss making before cost of capital.
Wow. Well, I know energy, and I'd like to get into banks a little bit, because Europe still has so many big banks. But first, do you mind going through technology a little bit? Because I think Europe, the conventional wisdom here in New York is that Europe doesn't have big tech. I always found that a little odd, given that all these technology companies in the U.S. were founded by people with European ancestry, and there is tech in Europe for sure. I mean, clearly the economic powers that UK, Germany, they are technology leaders for hundreds of years. So, could you talk a little bit about the state of tech? I mean, we all make our semiconductors with a technology from a Dutch company. Just a lot of people in the U.S. don't realize that, which is critical. Maybe you could talk a little bit about the state of European tech.
It's such an interesting question. It's this is a cause of endless mystery, and I still can't really work it out, because so of course you go back 20 years, and the very first form of Facebook was European the very earliest search engines were all European. The best search engine in the world at one time was a Norwegian company, which has since disappeared and gone bust. And of course, things like server computing, SAP, whether they're first to create something for large Fortune 500 companies, but they've been successful, they still dominate. So why isn't it a bigger part of the economy than why isn't it a bigger part of the economy than it is? And so of course the obvious things you look at are stuff like tax and incentives. And again, even then it's not obvious. I mean, taxes aren't that much higher in Europe, if at all, than they are in America. It may be a little bit easier to hire and fire people in America, but it's not obvious, why it should have so much more taken root in the US than in Europe. And our guess is it's something to do with, you have one population, one language, so it's quite easy to roll out across your whole population of product. Whereas in Europe, of course, we can't do that. I mean, SAP have managed to do it, and companies, as you say, like ASML, have created a product which people can buy. But it's been, search engine in Norway, it was just kind of a difficult thing to spread it across Europe because you have rules and regs. It's hard to. So I think that must be something to do with it. And I think the other thing must be something to do with the way your education, your universities work in America, which have a much closer relationship with the private sector. And I think that's, it's kind of slightly depressing, really. If you look at Oxford University and the amount of money which is spent on tech, and they think it's a great excitement that they managed to find 100 million to invest in a few startup tech companies. But of course, that's Harvard for probably 12 hours of,
Right.
in a day, and it's a whole year. And so it's just, the whole kind of the way that, closeness of kind of intellectual capital and money and people willing to put money into new technology, which perhaps they aren't so much here, seem to have ended up with us being kind of left behind. And we do, as you say, have some great strengths, but it's nothing compared to what you've managed to achieve.
But do you think that there is, where do you think things are? And you do have some big companies like ST Micro, like ASML, like Infineon and things like that, but maybe less on the consumer tech side, or, internet, I'd say. But where are you seeing some real winners emerge?
Yeah, we got some. I mean, the one we quite like, Kieran, is SAP. And SAP is kind of arguably, they've been a little bit behind the curve, slow to move on to the cloud, which is what clients want, and slow to create a product which you can pick or choose at different verticals rather than getting the whole integrated thing. But our guess is that they've managed to move the tanker, and they seem to be doing better than Oracle. And so I think that's a very reasonable company, and we have a large shareholding in it. I mean, our guess is that most analysts haven't quite appreciated just how the economics of moving to the cloud works, because of course cloud is spread over a period. You don't get the upfront license payments, and so when you're valuing the earnings, you've got a DCF back, over however long the agreement is, which of course gives you and then take that off the market cap. It makes it shares appear quite a lot cheaper than they would kind of look optically. But of course that'll all work its way through, and once cloud becomes a dominant source of revenues, then you'll see it up there in the numbers, and that's in the process of happening. The other area, of course, is all around semiconductors. And again, this is another mystery to us, because my wife is Dutch, and we know a lot of people who work for ASML. How the hell have they managed to do it? Well, they had one focus. It came out of Philips. But what is extraordinary is ASML is near a little town called Eindhoven, and most of the employees there are graduates of Eindhoven University, but somehow it works, and they've managed to create a product, and they've been able to master the technology race, and the Japanese have been left behind, and that's kind of really surprising and interesting. The other area, of course, you mentioned is Infineon and ST Micro and Soitec, and also we have a quite interesting company, Soitec, which has developed, as it were, an enhanced version of silicon, which is much less battery draining, very useful for using in mobile telephones. And where they have a more monopolistic position, but it's kind of few and far between. I'm afraid it's few and far between.
Well, how about banks? Do you mind going through banks, because I think they're not only cheap. We, in full disclosure, we own some European banks as well at Old Farm, and what struck me, I mean, they have the same rate environment that we do in the U.S. and Europe, but they're not only cheaper, but they pass on those higher rates less so than their American counterparts, and so thus their earnings are extraordinary at the moment. So maybe you could tell us what you think about European banks.
I mean, I think there are two or three things I think which maybe three important things which many people, and understandably, particularly if you're looking at American banks, perhaps don't fully appreciate. And the first is, I mean, our banking system is kind of unusual in that it's basically funded by current account surpluses and deposits. So current account surplus, it could be I could have like £500, £1,000 in my current account, and I could have a deposit. It might be £5,000, £10,000, something like that. There'll be some corporate deposits. There's not much securitization of lending. There's some, but there's not really very much. There'll be a bit of wholesale funding and there'll be equity. So of course, what happens is when interest rates go down, the cost of funding basically stays flat because your biggest cost of funding is current accounts, which don't ever pay anything. It could be like 25%, 30% of the liability side of your balance sheet. And but the benefit, of course, is rates move higher, then the cost of funding doesn't rise. There's a little bit of pressure on deposit accounts, particularly large, like £20,000. And if you want to leave your money in for 3 months, 6 months, a year, you're going to get quite a decent rate. But that's a very small part of the balance sheet. So it all feeds through. And then, of course, the obvious question is, well, why isn't there not more pressure? And of course, there's not more pressure because people want instant access. If they have a deposit account, it might be £1,000 or £2,000, £5,000, but they want to get their money back within a day's notice, something like that. And of course, if you're going to offer that, then you don't have to give much of an interest rate. But the biggest chunk is just current account where you don't pay anything, and there isn't really a demand for it because people want it's very flexible money in and out. It's a small amount of money, so it doesn't. Consumers aren't really. It's not something they really pay any attention to. So I think that's really, really important. This fixed rate of funding, this rates rise, it really moves all through the bottom line. I think for me, the second thing, which is really, really interesting, is our banks are generally, now this is very controversial, but our banks are generally better capitalized than US banks. So whatever way you look at it, most of our banks are something like a CET1 of 13, 14, 15, 16%. And as far as we can understand it, I mean, I know there are different ways of adjusting for it in the US, but the US banks are something near to 10, 11, 12%, something like that. Then if we look at leverage ratios, also European banks appear to be stronger. And if you look at things like liquidity, European banks, again, they appear to have a bigger coverage of the kinds of loans which they could be, or the kinds of deposits which could be immediately withdrawn. There's a great amount of cash on the asset side of the balance sheet. So I think that's really, really important too. I guess the last thing is this, just this whole process of kind of cost cutting and digitalization, which many have been really very skeptical about. And it's a really big deal because, of course, over here we have quite high property costs. And if you can move your clients onto the app, and if you can close down a branch, and if you can even do things like mortgage discussions on Zoom, then that's you're saving an awful lot of money. And then if you can start to use the app in a way where you can sell other products too, it's a very cheap way of being able to sell things like insurance or other savings products. So our guess is that the way we've done it is we've just gone for the strongest and best banks. So the ones which have 20% market shares, like Lloyd's or like Intesa Sanpaolo, those kinds of banks are really the strongest of the strongest. Because there, of course, you have the most amortization of your cost base, the best opportunity to amortize your cost base. And our guess is most of these companies should be steady state making 15, 16% returns on capital. Why so high? But they're the strongest and biggest, so they should be making 200 or 300 basis points more than the competition.
And Stuart, is it like a turn in the road, this rate environment change? Because I mean, I've looked at UniCredit, for instance, in Italy, which is the leading bank there, and they had a big year last year, but on a 20-year chart, I couldn't even see the move. It was so small.
I know. Well, we're so with you on that, Kieran. We think the valuations are just, in our view, just nuts. And I mean, the difficulty, it's so interesting with the question you raised, because, why is it? Why have they not moved up more? Because, everything people like me talked about, and yourself, this thing of rates moving higher, it all going down to the bottom line, the cost cutting, there being no more need to rebuild balance sheets further because we're already way above the kind of the harshest, Basel IV rules. Why haven't they gone up to discount, or at least gone up to their book values. And because they should be able to cover their cost of capital, and of course, the best like UniCredit or Intesa should be able to do 200, 300 basis points sustainably above their cost of capital. I mean, that's what happens in a capitalistic system if you're dominant. And our guess, and this leads us to a really interesting question, our guess is it's all around, it's a question of NPLs. It's a question around credit defaults. So we think deposit betas will gradually move higher, but that's all in our numbers and expected. Even at the maximum point, it'll mean that net interest margins are substantially wider than they were when interest rates were very low. So we think that's all fine. We think fee income is fine and all that, and maybe with the investment banks, maybe a little bit lower as we have less M&A to have to. But again, that's all kind of fine, and you predict that. The big question is around NPLs. And we have a slightly different view than many on this. I mean, you will read all the research reports, and they're talking about, particularly in the US, a sharp uptick in defaults. So we think it's unlikely in residential mortgages in the UK, and for the obvious reason that the loan to values are now under 50%. It's a completely different market to what it was around about 2000 or even in 2007, 2000. A completely different market, and we haven't seen any pickup in defaults with high interest rates and with the cost of living and all that. Credit cards cyclical. Again, we think credit card defaults will pick up a bit. But again, our guess is that most of the new credit card defaults are going to be coming from challenger banks like Virgin and Metro and the others. So the big question is on corporates. And our guess is that this time round, the really big defaults are unlikely to be in the banking system. They're more likely to be in private equity and with wealthy individuals and in the insurance industry. So some of the craziest lending we think has been in technology and startups and leveraged finance. And that's something which the banking industry is not really involved in anymore. Deutsche Bank will have a little bit, but it'll be tiny. It'll be basis points of the balance sheet. The rest of the banking system has basically exited all that kind of, we'd say, clever kind of merchant bank, investment banking type of finance. So we think there are some really nasty defaults which are waiting in the insurance industry, because insurance industry have been buying some of this very clever, whether it's mezzanine debt or this or that, something yielding a little bit more or being a little bit more clever. And our guess is that's where the really, really nasty defaults will come. And of course, CRE is the other area.
Right.
But CRE is European CRE. We don't have any of the stresses like you have in the US. I mean, of course, there's the effect of people working at home more. So there could be some, there's the effect of shopping malls. But again, it's a very small part of balance sheets. It's not like in the US where you have the regionals with a very large chunk in kind of shopping mall type finance.
I want to get a little bit into how you build a multi-billion-dollar firm and the culture, but the last thing on the investment side and theme side of things, I'd love to understand a little bit better, because you say right off the bat that it's an old economy, viewed more old economy in Europe. Do you think that we're switching a little bit, or because globalization is, we're not exactly in a deglobalization phase, but it's certainly receding. Do you think that just broadly should benefit Europe combined with a very low valuation?
Yeah, I think you're right. I think that's a really big deal. I mean, it's so difficult to measure, and we try to find examples of it, and it's kind of hard. You can find the obvious ones with the various Trump tariffs when he was president that were introduced, where people lost business, but it's quite difficult beyond that. I mean, our guess is that maybe it's even more simple than that, is that we had an extraordinary environment of quite fast growth, consumer spending, and very low interest rates. And of course, that really flatters the valuation of consumer-facing stocks. And now we're going to an environment where the consumer spending is not quite as buoyant as it was, and interest rates are higher. So you have downgrades in your numbers, plus you're discounting your interest rate fact is a lot higher. So if you look at something like I don't know, Nike, or could be Adidas in Europe, I mean, these are companies which had a very nice growth rate. Of course, the growth rate now has slowed down dramatically, and the cost of their discounting factor on their earnings has gone up. So I mean, the shares have been derated, but we don't think anything like enough. And of course, the flip side of all of that is our metal and mining stocks. I mean, it should be the environment for these companies. I mean, they should flourish at a time when, when we've had a period of starved investment and where the overall economic growth remains reasonable. I mean, our guess is that's where the earnings surprises will happen, and the earnings disappointments will continue to be in consumer-facing stocks.
I see it too. Let's see. I'd love to understand. You've survived a few big cycles, and you're one of the bigger absolute return firms in London. And I'd love to understand a little bit more how you build a culture. I mean, you talked a bit about research and how it's important and taking emotion out. But, I noticed over the years you put out a lot of research and you put a lot of your analysts and other portfolio managers' names on it. And can you talk a little bit about how you build a firm with where finding great ideas is primary?
I don't know whether we got it right or not, but certainly I think it's a nice place to work and there's a good atmosphere and people love what they do and they kind of throw themselves into projects. And I think how we've maybe been a little bit more successful than other people. Well, we have the privilege of being a partnership, so we don't have a board who's skewering us, making our lives miserable. So we can really we can think very carefully about and the long term and how we create the best possible environment. So what we've done, Kieran, is a bit unusual. So we've tried to pull together a group of people that have known each other for many, many years, decades now, who really respect each other and where individually they think they have extraordinary expertise. So you're going to be quite shocked. Out of a team of 8 of us, 6 of us have now worked for 30, 35 years together.
Wow.
And so Christina, Julian, and I worked back at Morgan Gruffel in the earliest days when we left university, and we've been one way or the other together ever since then. The other analysts, they were on the sell side, so they're working for large brokerage firms. Pascal, for example, was perhaps the best known growth company analyst, certainly in France and in Europe. Piers was a very well-respected German analyst. So we pulled in people that we worked with very closely for the last 35 years, brought them into our company. And I think that's a real strength. The more junior, well, I say junior ones, Lucas is very senior, but he's only been with us for 10 or 11 years, which is quite a short time. And he's kind of our freshest blood and has all sorts of great input and areas where he has an expertise. And then we have one new guy, Dom, who just started with us. We're very strange, Kieran, how we do things. He did a year internship to make sure he was happy with us and we were happy with him, and then we offered him a full-time job. So I think there are benefits of that. I mean, of course, there are risks as well. We could be getting a little bit too sleepy. We could be, because we've all worked together so well. But I think the benefits, in my view, really outweigh the risks. And because we've all done it for so long, we have a very long-term perspective. We don't get too panicked about share prices up and down. So that comes to our thing of writing the really in-depth research, because we get something right. Our view is that we're going to make 4 or 5 or 6 or 7 times in the shares. So if you remember, Kieran, when we bought the shipping companies, we did a great deal of work. And I think in Maersk, in the end, we made 7 times our money. When we've made a bit of money in the banks, we've made 2 or 3 times, but our guess is they'll probably double again before we get to the end of this bull market. And the oil and gas companies, we haven't made as much money as we hoped. We've done very well in the drillers. We've made 2 or 3 times in the drillers. We've made a bit of money in the oil, on the majors. But our guess is that Noble Corporation will double again, and our guess is that Total and BP will double again to get back to a fair normal valuation. So for us, it's worth it to spend months doing the super in-depth work and speaking to all sorts of experts across the world if we think we can make 5 or 6 or 7 times afterwards.
Wow. I mean, I totally understand that. I wish I had that patience as well to spend that kind of time and be there at the right time. It's a very interesting backdrop for Europe. It is because not only I still feel sentiment. I'm sure you feel it too, right? When you come to America, that sentiment is like, well, why would I own Europe? Is that right? Accurate? And
it's
yet
terrible,
you have the valuation on your side, right? And you have potentially some real catalysts. Is that accurate?
It's you're absolutely right. I mean, some of it is kind of true. I mean, at the end of the day, it is a bit harder to do business in Europe, and it costs more to lay people off. And but there are benefits of that too. You can get productivity is generally quite high, particularly in France and Germany. So it's a very, very difficult one. Taxes, I'm not sure that much higher in Europe than they are, because there are all sorts of special deals in different regions. So I think it's a more level playing field than you think. I mean, our guess also is that saying this as a European is that for France and Germany, this is just the linchpin. There've been, most French people, German people, Dutch people, either it's their parents or grandparents or great-grandparents. So there have been tanks rolling over their lawns. They have ancestors who fought and died for their country. This is a really, really, really big deal for us. And so we think it's still got legs. I mean, the big question is whether we can get, as we very interestingly asked whether we can get further integration. I mean, my guess is the back of Ukraine, the back of COVID, and the recovery fund. I think it's likely we should be able to move a bit more closely together than we have been and solidify the whole project further.
Well, Stuart, absolutely great. I think you did a great job, and I really appreciate walking through these ideas. It's a very interesting area, and you're one of the survivors and thrivers in London.
Yeah, one of the very few survivors.
But wonderful to speak with you about this, and thank you for your time.
Thank you for listening to the Thematic Investors Podcast, powered by Vidrio Financial. With Vidrio Financial, asset managers, endowments and foundations, pensions, family offices, insurance plans, and sovereign wealth funds can cut through the complexity of asset allocation to reduce costs, mitigate portfolio risk, optimize compliance controls, and improve performance analytics. Interested to learn more? Contact us today at vidrio.com. That's vidrio.com. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Vidrio Financial and or our host, Kieran Cavanna. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.